Going back 7 years ago, you were in a very similar position to Lyft in the sense that you had founded and you were running a company that was disrupting a very long-established industry. Top-line growth, but not making money. Shares pricing above the expected range, which is what's anticipated now with Lyft. And then also going head-to-head chiefly with one other main rival. How would you advise Lyft going into their IPO tomorrow? And more importantly, what do investors need to keep in mind that maybe they're not necessarily thinking about in the coming days and weeks ahead?
Yeah, so this is an incredibly exciting day for Lyft. They've been working on this for many years. And today is a monumental day. Look, the opportunity in front of them is this $1 trillion annual spend by American consumers on transportation. And so, right, the $2 billion a day, obviously losing a lot of money. But the company has kind of started clearly pretty slow. They let Uber take a lot of the narrative, but now they're fighting back. And their entry to go public first is absolutely a sign that they're trying to take the narrative back. They're trying to come out into a leadership position to be seen as the innovator, to try and catch up to where Uber is today. And so that's kind of working. Obviously, the losses are enormous, but the opportunity is enormous. So they've gone from 25% market share to 39% market share, and now they're obviously raising a bigger war chest to do that. I think the real question, kind of long term, is kind of how this market plays out. So it's in many metros, it's turned into a duopoly between these two companies, and Lyft and Uber obviously are fighting out. Is this going to turn into a price war? It's already an epic war, which is kind of fascinating both consumers as well as the media and the financial press. But is it going to be a price war? Is that going to be bad for investors? Is that going to be bad for the companies? My sense is it's not going to be a price war. You've seen both companies, they want to be successful. They've been mirroring each other's pricing somewhat, mirroring each other's kind of businesses somewhat. And now they'll look to differentiate in the eyes of consumers and the eyes of investors. Certainly for Lyft's perspective, their differentiation comes from being singularly focused on this transportation opportunity. And also singularly focused on their brand. I know when I was running Trulia,
and that's my concern looking at this S1 is that Lyft spends so much to keep drivers happy. Whenever I ask drivers, Lyft or Uber, who do you like better? Most of them drive for both. They talk about the incentives they get from Lyft. I know as a rider, I get incentives from Lyft. Once both of these companies go public, there's going to be pressure on those incentives. And frankly, Uber has the scale to come out ahead, don't they?
I think that's the fear. That is absolutely the fear from investors. So looking at the real estate marketplace industry, we looked at it globally and said the number one generally takes 60% of the profits. The number two generally takes 20 to 30% of the profits, and the rest is shared between the other players. It's likely that in these marketplace businesses, in transportation, the same things happen. And so this is why Lyft is being aggressive again. They don't want to be seen as the number two. They want to be seen as number one. And that singular focus on transportation, whereas Uber is spread geographically across multiple continents, is spread across Uber Eats and obviously Uber Freight and the core businesses. What Lyft is counting on is like that singular focus to own that square on your home screen, own the mobility application, creates the opportunity that over time they can creep up that market share to become the number one. And that's obviously the kind of fear for the companies. It's longer term, the question is around autonomous. Longer term is like, how does the markets, how do the businesses evolve? Can they capture market share, and what does autonomous look like? And both of them, we're trying to kind of gain market share, own that homepage own that button on your home screen to make them well positioned for autonomous.
A lot of focus on the dual-class share structure that Lyft is implementing, the so-called super voting shares, no sunset provision. Uber's not going to have that in place. Is it a mistake for Lyft to implement that?
So look, this is, it's essential that companies need to think long term. So interesting, Trulia went public second to Zillow, and Zillow took a bunch of the narrative. They captured investors' mind share. We didn't implement a dual-class stock structure, so to maintain founder control. And then, as you know, latterly the companies merged, and I sat on the Zillow board, and really saw firsthand how a founder-controlled company helped them to think long-term. And this is a long-term battle. This is not about market share gains this quarter or next quarter. It's about who's going to win or be best positioned to win when autonomous becomes a mass market proposition. And so the founders need to think long-term. And it was fascinating to see Zillow think absolutely long-term from the outset, and kudos to them. And I think at the margin, while it's marginal, it made us think a little bit more short-term. And so it's absolutely the right thing to do for Lyft to have this structure. Investors may not like it, but to really capture the long-term opportunity, I applaud them for doing this, even if it makes a few investors upset.